The world of exchange-traded funds, ETFs, has witnessed a significant transformation in recent years, especially in the midst of a high-interest rate environment. As investors hunt for attractive yields, active ETFs have gained momentum. In this article, we will delve into the dynamics of active ETFs, with a particular focus on the YieldMax Tesla Option Income Strategy ETF, TSLY. Market Overview. Active ETFs have been making their presence felt in the financial landscape, offering investors a range of strategies to capitalize on the evolving market conditions. One standout player in this space is the J.P. Morgan Equity Premium Income ETF, JEPI, with assets exceeding $29 billion. Its success has also rippled into its sibling funds, JEPQ and JPIA, which have been witnessing substantial investor interest. Furthermore, the YieldMax Tesla Option Income Strategy ETF, TSLY, has rapidly emerged as an attractive choice, despite being relatively small in January. Created by YieldMax, TSLY now manages over $747 million in assets. The fund's performance has been impressive, consistently attracting inflows every month this year. In total, the fund has accumulated more than $925 million in investments this year alone. Understanding TSLY's appeal. TSLY's magnetic allure to investors lies in its advertised yield. According to the ETF's official website, TSLY boasts a distribution rate of 57.07% and a 30-day SEC yield of 6.03%. The distribution rate is a key metric representing the annual yield an investor would receive if the most recently declared distribution remained constant. However, it is important to note that this rate may not accurately reflect the actual earnings due to the changing investment landscape. Challenges and risks. Despite the seemingly attractive yield, data paints a different picture for those who invested in TSLY when it was launched. An investment of $10,000 made on November 25 the previous year would have eroded to $9,071 as of today. This stark reality raises several concerns. TSLY's unique composition is a contributing factor to this underperformance. The fund employs a relatively complicated financial engineering process. A significant portion of its assets consists of short-term U.S. government bonds, a smaller allocation in cash, and a substantial amount invested in Tesla options. One distinctive feature of TSLY is its use of a synthetic covered call strategy. In a traditional covered call approach, a fund sells an option of a security it owns. However, in a synthetic call strategy, the fund does not own the actual asset but instead creates a synthetic asset that mirrors the real one. This approach can add complexity to the fund's operations and introduce additional risks. Recommendations and insights. Considering these intricacies and the less favorable performance, caution is warranted for investors, especially those with limited experience, when considering TSLY. Over time, the fund has experienced a decrease of approximately 4%, while Tesla shares have risen by more than 10% since its inception. Moreover, it is essential for investors to allocate their funds in assets they fully comprehend. Unfortunately, many regular investors may not have a clear understanding of how TSLY and other covered calls work. This lack of understanding can lead to unexpected consequences and risks. Another crucial aspect to consider is the expense ratio associated with TSLY. The fund comes with a relatively high expense ratio of 0.99%, making it a costly ETF to own compared to alternatives like JEPI and JEPQ, which have expense ratios of 0.35%, and Invesco Nasdaq 100 ETF, QQQM, with a ratio of just 0.15%. Market observations. As we examine TSLY and its performance, it's important to contextualize it within the broader market landscape. Here are some observations and insights to consider. Market sentiment and yield chasing. The current high-interest rate environment has created a climate where investors are actively seeking out higher yields. This trend is not limited to TSLY, it's a broader market sentiment. As a result, ETFs that offer attractive distribution rates and yields have gained popularity. Complex strategies. TSLY's use of synthetic covered call strategies and the composition of its assets in U.S. government bonds and TSLA options are not unique to this fund. Many active ETFs employ intricate strategies to achieve their objectives. Investors must carefully assess whether they understand and are comfortable with these strategies before committing funds. Performance versus benchmark. TSLY's underperformance compared to its benchmark, represented by TSLA shares, highlights the importance of evaluating a fund's returns in relation to a suitable benchmark. In this case, the 4% loss in TSLY pales in comparison to TSLA's 10% gain. Expense ratios. The cost of ownership, represented by the expense ratio, is a crucial consideration when investing in ETFs. TSLY's relatively high expense ratio raises questions about whether the potential yield justifies the cost. Risk versus reward. TSLY's journey and outcome underscore the classic investment principle: higher potential yields often come with higher risks. While the allure of a 57.07% distribution rate may be tempting, investors must weigh the risk of underperformance and the complexity of the fund strategies. Conclusion. The world of active ETFs offers a diverse array of investment opportunities, but investors must approach them with caution and a clear understanding of the strategies employed. The YieldMax TSLA Option Income Strategy ETF, TSLY, is a prime example of a fund that, while offering an attractive yield, carries its own set of complexities and risks. In the current market environment, where yield chasing is prevalent, it is crucial for investors to conduct thorough due diligence before venturing into such investments. While TSLY's high yield may appear appealing, the reality of its performance and the intricacies of its strategy should give pause to investors, especially those who lack a deep understanding of the fund's operations. Ultimately, when navigating the landscape of active ETFs, it's essential to strike a balance between yield and risk, align investments with your level of comprehension, and consider the cost of ownership. As the financial world continues to evolve, investors must adapt and make informed decisions that reflect their financial goals and risk tolerance.